This is the current federal tax developments for the week of June the 23rd, 2025. Current federal tax developments are brought to you by your state society of CPAs. Ahmed Zoller is coming to you from Phoenix, and we're going to be looking this week at three different topics. Wasn't a really big week in the sense of lots of developments, but there was one kind of big one we'll cover at the end. Going to first talk about a collection as due process case, the case of Schwartz versus Commissioner. And we're going to look at the problem Dr. Schwartz had with not having his estimated tax payments in compliance when attempting to get an installment agreement approved or an offer in compromise approved. And so we'll go over that and why the court found the IRS did not abuse its discretion by saying, look, you're behind on your estimates, you're not keeping up at all. There's really no point in giving you a collection alternative. We'll also talk about a case that is a comedy of errors by pretty much everybody. The case of Cano versus Commissioner. It officially looks at the validity of a notice of deficiency and the impact of address errors. And actually, it does correctly look at that. Although I ultimately think the court said, I got a way to just fix this whole thing immediately. So, yeah. And so we got the answer we did. And then finally, this week, the Senate Finance Committee put out its draft of tax provisions for the upcoming reconciliation bill that the Senate's going to try to bring to the floor this week. And we'll talk a little bit about the key differences between the House and Senate provisions that have come out as we discuss this. Remembering, of course, it is a proposed law. And neither one of these is likely to be enacted as is. Pretty much guaranteed we're probably waiting ultimately for a conference bill, assuming they get a bill through. And yes, I know Senator Thune said failure is not an option, but the senator should know this is Congress and failure is always an option, even if it's one that could prove very costly to you in the election. But it's an option. This is Congress. They can foul things up. Right? Senator Thune's been around long enough. I think he understands that. He just also understands that there is no way that this is going to be really bad for basically for the Republican control of Congress if they screw this up and can't get anything through. But let's go away from Congress temporarily. Let's take a look at the critical role of estimated tax compliance in collection due process cases. This is a case of Schwartz v. Commissioner. It's a tax court memorandum decision 2025-64, issued on June the 16th. Now, basically what this case involves in is Dr. Stephen J. Schwartz challenged an IRS appeals office determination upholding notices of intent to levy for unpaid income tax liabilities for 2013 through 2015. Now, Dr. Schwartz's tax liabilities totaled just over $330,000 as of July 8, 2019, and that was following a stipulated tax court decision. Dr. Schwartz is going to end up in tax court 3 times. That was the first time the tax court over these issues. Now, initially, he filed for a collection due process request because, okay, he agrees now he owes that $330,000, entered into a stipulated decision, but he's saying, I'm not going to be able to pay that. I can't just write a check. So he sought basically a collection alternative, and he pretty much asked for 3 options. He said, he was asking to inquire or, try to get one of these 3, which would be an installment agreement. That would be for $1,500 a month on his payment, an offer in compromise. And for those who don't immediately know what that is, he would propose to offer to pay off a reduced amount, basically in a compromise, or finally just saying, I can't pay the balance, which is looking to get the thing kind of stuck over on currently not collectible status. So he's looking for some option there. The IRS, of course, is looking to collect the $330,000 the court just said they are owed. Right? As I've always said, there's a world of difference between getting a judgment and collecting on the judgment. Of course, so IRS is in the collection on the judgment mode. Now, the IRS requested at various points in this updated Form 433As to show Dr. Schwartz's financial condition. They also looked at tax returns for those years and proof of estimated payments. And again, he was proposing, his primary proposal was $1,500 a month installment payment agreement. Now, initially with his first collection due process hearing, the appeals officers rejected the installment agreement and sustained the levy. Dr. Schwartz took that to tax court. The tax court essentially remanded the case to appeals office because they were concerned about a few things. There was the calculation of gross income the appeals officer did. They found issues with that. They also wondered about the relevance of Mrs. Schwartz's income because she had been granted innocent spouse protection for this claim. And finally, they also wondered about certain expenses of Dr. Schwartz that were disallowed when computing his ability to pay. So a new appeals officer scheduled a May 2023 hearing specifically to deal with these concerns the court had raised about the initial proceeding. So on remand, the appeals officer requested updated financial information and proof that Dr. Schwartz was current with estimated tax payments, for the following years. Dr. Schwartz provided his 2020 return, documentation of his 2021 filing, and an extension for his 2022 return, right? Other financial documents, and again said, I want a $1,500 per month installment agreement. Appeals officer found a few things, 3 different issues that the appeals officer felt were a problem here. First, the appeals officer determined that Dr. Schwartz was not in payment compliance with estimated tax obligations for 22 and 23, with an approximate $56,000 just under tax shortfall, which would make him ineligible. He's not keeping up with installment payments. Secondly, also noted that there was over $490,000 per the officer's equity in Dr. Schwartz's primary residence. And the officer suggested that should be used to substantiate the liability, to be able to satisfy the liability. He could use that equity. Finally, the court noted Dr. Schwartz failed to disclose the correct value of his retirement holdings, right? The various retirement accounts. They said that made it difficult, impossible to determine what his ability to pay truly was. Now, ultimately, the appeals officer concluded the first 2, either one standing alone, the estimated tax obligation not being current or the large amount of home equity, would be sufficient to deny the agreement. So essentially, the appeals office denied the installment agreement and sustained the levy based on these 3 independent issues. Dr. Schwartz again decides it's time to go back to tax court. Now, this case comes before the court. The court decides this is a case where summary judgment is the appropriate item to be used here. We can just do this right away. It's used to expedite litigation and ignore unnecessary trial time by granting judgment if there's no genuine dispute as to any material fact, and a decision can be rendered, therefore, solely as a matter of law. So we can go from the submitted briefs because the parties aren't disputing the facts. The facts they agree on, right? So the question is just going to base on that. Now, the standard review for collection due process cases, if the validity of the tax underlying the assessment is not in question, the tax court reviews the appeals office's determination only for an abuse of discretion. Did they abuse the discretion they're granted under the law? So essentially, an abuse of discretion is defined as if the determination that the appeals officer came up with was arbitrary, capricious, or without sound basis in fact or law. Those are the criteria under which basically the court can overturn or remand back for another hearing this determination that the IRS can go ahead with its levy. Now, the court said, look, this obviously is a case that was ripe for summary judgment. And so they reviewed the notice of determination and the administrative record from the case. And under 6330C3, the court looked at 3 factors in determining if the IRS had properly come to their conclusions in this hearing. Did the officer properly verify legal administrative procedures had been followed? Did the appeals officer consider the relevant issues that were raised by the taxpayer? And did the officer consider whether the collection action requested would balance the need for efficient tax collection with the taxpayer's concern for minimal intrusiveness. The court found all three requirements were met by the appeals officer in this hearing. On verification, the court found the appeals officer conducted a thorough review and verified that all requirements had been met. Number two, Dr. Schwartz's only issue was the $1,500 installment agreement, and the appeals officer considered that issue. Should we grant Dr. Schwartz a $1,500 installment agreement and therefore hold off on the levies, or should the levies go forward? Now, the court found it was really important the fact that Dr. Schwartz had not been complying with his estimated tax obligations. That on its own is sufficient to justify rejecting any collection alternative. The court cited cases like Giamelli versus Commissioner and Hartman versus Commissioner, which each stated that a failure to make estimated tax payments standing alone is sufficient to have the IRS deny you a collection alternative. In this case, go forward with their levies. Now, what's the rationale for you having to pay your estimates? Simple rationale, as the court pointed out, is it ensures the taxes currently are being paid and avoids what the court calls the risk of pyramiding liability. That is, while you're now granting him the right to pay off prior years, as he's doing that, let's say over the next 5 years, he's just accumulating 5 more years of unpaid balances. So liabilities just keep stacking on top of each other. And that means that we're probably going to just constantly be going back and redoing this again and again and again. The fundamental problem is that Dr. Schwartz is not paying the taxes currently. That was the fundamental problem. And if he doesn't get current on his estimates, doesn't have sufficient amounts withheld, it's just going to keep happening. And that's the view of the court. The appeals officer noted there was a pattern of significant underwithholding of tax dating back to at least 2017. So this is something, it's a pattern. That's how we got into this trouble. That's how come we keep getting these things coming up. Now, honestly, it's very possible with these other years and with these years in question and before the IRS that he may have been avoiding refunds. But avoiding refunds is one thing, and getting it paid in just perfectly, that's fine. But if you're basically getting, as I said, nearly $56,000 in the hole, that's big shortfall, taking amounts less than. And I understand clients have trouble with that because they are living beyond their means, and it's very difficult for them to dial it back. And unfortunately, a lot of people who have trouble with money, and sometimes very high earners do, they only worry if there is a problem they can't make go away today. So they don't worry about not paying estimates, don't worry about having little withheld, because today that allows them to still go ahead and make these other bill payments, right? And the IRS and the government don't come along until, let's be honest, much later. But that is the reason why the estimate rule is here. Once you're in trouble, yeah, we're not going to assume you're going to pay the future taxes. You got to actually do it. Now, Dr. Schwartz argued that the Internal Revenue Manual required the IRS, I think the big word here, the problem he has is this word required, to include delinquent estimated taxes in an installment agreement. It only required the employee to do so if they decided to grant an agreement without having them up to date. But it never mandates that they do it. And as the court pointed out, the Internal Revenue Manual does not confer any rights on the taxpayer. Those are instructions from the IRS supervisors to their employees. They are not rights a taxpayer can take advantage of. And so therefore it doesn't work here. So what was the conclusion in this case? The court found, given Dr. Schwartz failure to respect his estimated tax obligation and his long pattern of, per the court, flouting the payment of his proper tax liability, the court said there was no abuse of discretion here. Right? In essence, the appeals officer properly concluded that balancing the interest of the government to get paid versus the inconvenience for Dr. Schwartz's actions meant that he would need to tolerate this inconvenience, right? Because he does not appear capable of getting, basically getting his act together. So, more draconian measures must be taken for the government to get its money. The summary judgment was therefore granted for the commissioner, and the appeals officer termination to sustain the levy was affirmed. Look, guys, it's really, really important that your clients who want these collection alternatives understand the rule about keeping up their estimated payments. Coming back in and trying to do it. In this case, remember, he was appealing. Well, okay, he's appealing them, but now they're just going back, and you've got to be current. If he already had the agreement and he fell behind, it would have voided the agreement. So he's got to take care of that. Your clients can't just ignore the problem. But as I said, lots of times people that get behind on these things, quite often, they're just trying to get through today, and they don't really care if they're going to hit a brick wall in 6 months. And that's kind of the problem here. And the court is saying that's the reason why we have this rule, because otherwise this just keeps kicking the can down the road. And we need to, Dr. Schwartz needs to get this under control. And then some leniency may make more sense. It's kind of the way the rules are looking, like it or not. So the fair and estimated tax compliance can by itself justify the rejection of IRS collection alternatives. Can they give it to you anyway? Yes. But again, please remember, with collection alternatives, you're basically asking for a favor. That's why they only look for abuse of discretion. They don't really go and review the case and have the court determine if the court would have granted. That's not how this is reviewed. And you're in much better shape if you have a situation where, the court's going to start from scratch. It's not what they're going to do here. Next up, the comedy of errors that is the case of Luis Carlos Ibarra Cano versus Commissioner, Tax Court Memorandum Decision 2025-65. Decision came down on June the 18th. This is a comedy of errors of the IRS, some potential errors by the taxpayer, which arguably, if he did err, helped him. It's just an interesting case all around. And frankly, I think a decision the court arrived at by saying, look, I'm not going to take the IRS's word that they're going to make this right, because if I just kick this out right now and say the notice was never valid, it's right. So we're just going to stop this here, because right now I have no confidence in the agency's ability to keep moving forward without more problems. So let's talk about this case, Cano versus Commissioner. Technically, this case looks at the validity of a notice of deficiency involving address errors and the requirements the IRS has to use the last known address to get presumption of delivery of the notice of deficiency. We're also going to talk about the concept of harmless error. If there is an error made by the IRS in the notice of deficiency, they can recover from that if they can show the error was harmless. Now, let's remember, generally, the IRS, for things other than math errors, has to issue a notice of deficiency, which gives the taxpayer 90 days to take the matter to tax court. And if the taxpayer fails to take the matter to tax court within that 90-day period, then the IRS can move forward with assessing, and collecting the tax based on a notice of deficiency. But they have to have a notice of deficiency issued before the statute expires. Okay. Now, the IRS determined that there was a $4,400 deficiency from Mr. Cano based on alleged wage income. Alleged, we'll explain why it's called alleged, because it's not there just to be like, something like an old police procedural where everything's alleged. Now, it turns out that actually it's alleged because it turns out the IRS later discovered it wasn't really the case. But we're getting a little bit ahead of ourselves. Now, the notice of deficiency was issued in January 23rd of 2023. The IRS's big error. This starts all the problems going. Mr. Cano's last known address was 220 6th Street in Hempstead, Texas. But the notice got accidentally addressed to 2206 TH Street, meaning they essentially flipped the 6 and the space. So the 6 got put on the end of the address number, 2206, not 220, and the name of the street lost its number. The IRS had a USPS, U.S. Postal Service, Form 3877, which for proof of mailing, which confirmed, unfortunately for the IRS, that the notice was sent by certified mail to the wrong address. Now, Mr. Cano eventually filed his petition because he wouldn't be in tax court unless he filed it. He filed his petition 400 days after the notice of deficiency was mailed, so he filed it in February of 2024. As you might guess, that's more than 90 days after the notice was issued. And therefore, this case initially came, the IRS responded to that petition by asking, filing a motion to dismiss for lack of jurisdiction, which it turns out the court will eventually dismiss this for lack of jurisdiction, but not the way the IRS wants them to. So we'll get to that point. It said his petition had not been timely filed. Mr. Cano did not respond to that. During a calendar call, however, the IRS counsel apprised the court of additional facts, and the court said, IRS, you need to file a supplemental memorandum to basically lay out these issues and how we're supposed to deal with them. Okay. In its supplement on May the 13th, the IRS acknowledged there was an address discrepancy on notice of deficiency, and it had been mailed to that wrong address. However, in this acknowledgement, in their filings, they argued that Mr. Cano must have received the notice because we have a court petition with the notice attached to it. Obviously, he got it. Okay. Therefore, the notice was valid, it conferred jurisdiction, and he being 90 days late, more 90 days, filing more after the 90-day deadline means that, tough luck, he can't challenge this, the assessment's valid, and we can move forward and collect from him. But they also discovered another issue. The IRS counsel also represented that they had discovered, looking in more detail of this case, that the alleged unreported income belonged to Mr. Cano's father, not Mr. Cano. Oops. So that the $4,400, he didn't know that. Now the IRS said, okay, don't just dismiss the case because it's past 90 days, but don't worry, court, we will fix this administratively to assure that Mr. Cano doesn't end up paying this tax. Okay, the court's like, we're going to handle this a little differently, IRS. The tax court said we must have jurisdiction to hear a case. So in a deficiency case, the tax court jurisdiction hinges on two things. There must have been issued a valid notice of deficiency because that starts the 90 days running. No notice of deficiency is ever issued before the statute runs out. There is no tax court jurisdiction, and the IRS is just out of luck on collecting any money from it because they must issue the notice, the 90 days runs, and then at that point, they could assess the tax and collect at will. But, that's step one. Step two, once there is a valid notice of deficiency issued, then the burden shifts over to the taxpayer to establish that they timely filed their petition. Now, a notice of deficiency is generally considered valid if it is mailed to a taxpayer at their last known address. The burden of proof is on the IRS. They have the burden of proving by competent persuasive evidence the proper mailing of the notice of deficiency. And typically, the IRS does this by demonstrating its existence and providing documentary evidence, generally the United States Postal Service Form 3877, showing that it was sent to the taxpayer's last known address. Once that's done, they have a presumption of proper mailing. Herein lies our problem. With the facts of this case, they can't meet that burden, right? There was not a proper mailing. They can't get this presumption because their evidence documents They did not send it to the last known address. They sent it to a probably non-existent address. So that's an oops. However, right, even if the address is wrong, the IRS may still be able to recover this if the taxpayer was not prejudiced by the error. Generally, that requires the taxpayer receive the notice with sufficient time remaining on the day they received it to petition the tax court within the 90-day period. And as you know, the core of the harmless error doctrine is whether the taxpayer had a reasonable opportunity to act on the notice despite the error. So the fact the IRS fouled up and addressed the envelope and addressed the notice wrong, that is not going to be fatal to the IRS as long as the taxpayer ended up getting the document in a timely fashion, so that it wasn't like they had to go down that night. You got it, you picked up your mail, you came home from work, whatever, or you were there at your home. The post arrives at 4 p.m., which I've had them do at my place more than once, 4 or 5 p.m. And when that happens, you suddenly discover that, hey, wait, I've got this 90-day letter and it's day 90. That would not be a reasonable opportunity to respond. And that last issue is going to be the IRS's problem with the harmless error doctrine. The court will find the IRS failed to issue a notice of deficiency. Why? What was the problem here? He got it. What's the problem? Well, first they said, number one, both the notice and the United States Postal Service form displayed an incorrect address resulting from that transposition of the digit 6 and the space. The court said this was not a minor typographical error, but resulted in what was almost certainly a non-existent address. The court could not make any determination about how the Postal Service would handle that delivery. I mean, obviously at some point they figured out how to get it to him. But how long did that take? Because how long that takes is going to be crucial here. The receipt without delay is your problem. The only proof the IRS has to prove delivery occurred 400 days after the notice was issued, well past the deadline for filing a tax court petition. Now, could Mr. Cano have had it before then? Possibly. I'm certain he did before day 400. But did he have it? How far in front of the 90-day deadline did he have it, if he even had it before then? Because that's a key issue. How far in front did he have? And there is no evidence whatsoever to establish when Mr. Cano got this. The court says, IRS, you haven't cleared your first hurdle yet. You need to submit evidence to prove this. You have not, right? So the case was dismissed for lack of jurisdiction because IRS couldn't get over the first burden of showing they had issued a valid notice of deficiency. And because we are now well past the deadline for issuing a notice of deficiency, case is done. IRS cannot collect any money from Mr. Cano for that year, which, by the way, coincidentally turns out to be the right answer anyway, but the IRS wanted to go through it and not have this dismissal on the record because it would be a finding of how you screw up your, issuing your notice of deficiency. So note, meticulous standards apply here to jurisdiction, both to the IRS and the taxpayer. The IRS has to meet the requirements of valid notice. The taxpayer has to file the timely petition, assuming the IRS meets the valid notice requirements, right? If there are substantial mailing errors, that can invalidate a notice of deficiency, even if eventually the taxpayer gets it, right? So keep that in mind. The mere fact they got it, which is what the service tried to rely upon here, doesn't suddenly make it good. It's just not the way it works. It is important that you validate that the IRS properly filed procedures in issuing the notice. Now, if the client's coming to you and there are 80 days left to file the tax court petition, then probably they're not prejudiced because they have it. But again, if somebody comes in and you're just about at the 90th day, then you may find some relief in looking at this route and saying, hey, IRS didn't properly issue this. And, it's 2 days before the petition would have to be filed or 1 day before. That's not a reasonable opportunity to contest it. We need to look at that. So be aware of those issues. Finally, this week, what really happened, the big thing, and I'm sure some of you heard about this, was that we had the Senate Finance Committee did release their draft of most of the tax provisions that they plan to include in their bill that would become part of what's referred to by the House as the One Big Beautiful Bill Act. That name may or may not survive the bird rules in the Senate and the bird bath. If it is objected to as a name, because the bird rules are rather strict that nothing should be in your bill that doesn't have a revenue impact, revenue impact or spending impact. And yeah, as they basically got really picky with the Tax Cuts and Jobs Act, it lost its name for that reason. So be aware of that. But we will go ahead and call it the One Big Beautiful Bill Act right now because that's what people know it as. So this is the Senate proposal. And what we're looking at here is how does that differ from what the House passed in their version when they kicked out and voted through the House version of H.R. 1. Now we're going to compare the House passed version of the One Big Beautiful Bill Act, H.R. 1, and the Senate Finance Committee proposed version of the bill, what they would do in the tax sections. Some key areas of distinction. One of the key ones is whether tax provisions will be permanent or short-term. Both bills have some provisions made permanent. Both bills have some that are short-term, but the Senate bill has way more permanent provisions. Now, this is the thing you might want to mark down. We will eventually, this bill, when it gets ready to go to the floor, and actually it's already started somewhat with Republicans, pushing this through, trying to clear up some of these things before we get to the floor. But the Democrats will also have a chance to do it. And I'm pretty sure one issue will be one the Democrats will bring up before the parliamentarian, which is in the process known as the bird bath. And it's referred to that because, hey, it sounds really interesting, given what we've got with the idea of Senator Byrd and just his name, and we call it a bird bath. We clean up the bill to remove provisions that aren't allowed under the bird rule. And the person who initially does that cleanup is the Senate parliamentarian. But it doesn't self-enforce. She doesn't just automatically pick up the bill and review every single detail to see if it qualifies. Rather, she will act if someone raises an objection. If there is an objection raised, she will review it and issue a thumbs up or thumbs down about whether it can stay in the bill. Now, in theory, the majority party could override her decision with a simple one-vote majority. However, because the Byrd rule is a special way you get around the 60-vote requirement to go to the floor, which is the key minority party right rule, and both parties know that there will be some time in the future they will be the minority party, it is considered dangerous. So while this is a tool that's been available for every one of these bills, nobody wants to use it because they realize immediately if you use it, what you've just done is make it clear that you could make a mockery of the Byrd rule simply by, didn't matter if a position was policy only. A position must be primarily revenue or spending based. If the primary purpose of the provision is really a policy provision, not a spending provision or a taxation provision, then it must be stricken from the bill. For instance, a couple of years ago, the Democrats tried to hitch on a provision that would have, in addition to having some minor revenue effects, have changed the minimum wage. That was taken out of the bill by the same parliamentarian we have now for failing the Byrd bath. right? It was objected to by the Republicans, and she said, nice try, guys, but this doesn't qualify. The number of permanent provisions you see in the bill, in the Senate bill, may go down dramatically quickly if she rules that current policy scoring is not allowed. You must use the current law scoring that's been used for all other bird, basically bird bills, shall we call them, in prior history, whenever we've used the bird rule. That's the main reason why the House has all these temporary provisions, is they're assuming it will be required to have a current policy score or a current law score. I get this right, in the Senate, which means we assume we do exactly what the law says. And the law says next year there's no QBI. The law says next year, the child tax credit changes dramatically. Next year, the standard deduction goes down. Next year, rates go back up. We assume all that happens, and therefore, when we are scoring how much you're spending in the 10 years, and we're scoring if it spends money past the 10-year end of the budget rule, which you're not allowed to do, you've got a net has no effect on deficits more than 10 years out. We have to consider those as, if you're going to make it permanent, then the big problem they've got is at the end of the 10th year, or whatever time period they do, the bill has to essentially, pay for itself. So they need revenue raisers to offset everything that either reduces revenues or raises spending more than 10 years out. And yeah, that one, a lot of people do not believe that they're going to go along with that one. The other problem is, even if she does, there's a good chance the Senate has to go back to temporary, because a lot of deficit hawks in the House literally said, when the Senate started proposing this current policy scoring, to on paper get around the bird rule, to a lot in a number of areas. Well, they didn't particularly care which rule they use, but they said ultimately it's still got to reduce deficits in the future. And, we compared to what we see today. And if it's not doing that, we don't really give a dang, which way, whether it was current policy or current law, we're voting against it. So, yeah, it could be a problem there. Individual tax relief, there's some differences there on specific items on certain business tax policy matters. And the timing of termination of the green energy tax credits is also a big issue, difference in the two. Please remember, both of these are proposed bills. Neither are enacted into law at the moment. The final outcome will probably be a compromise, but despite Senator Thune's statement that failure is not an option, my take is failure is an option, a really bad one. If you want to show that you're competent at governing, it's a horribly bad one. But to believe Congress can't screw something up, that takes way more faith than I suspect, the senator has in Congress as a whole. They can definitely foul things up. So remember, right now you got to remember, if they don't do anything, we are faced with all of these things, with a number of tax provisions ending at the end of 2025 and things reverting back to 2017 law. And most likely, if that were to happen, we would spend a good part of 26 with attempts being made to somehow extend those things. And yeah, it would, we would have a nice long period of total uncertainty. So yeah, that chaos would be that. Yeah, that'd be chaos, but don't discount that until the president signs a bill. That's all I'm saying. As Yogi Berra said, it's never over till it's over. We need the president's signature on a bill these guys, that both chambers pass. Until that, and by the way, until that, we have no idea what's going to be in the bill. It's likely that many of these ideas will make it into the bill. There's a good chance that where the Senate and House really have the same provision or very close provisions, we know pretty much what will make it in the bill if it passes. But yeah, just keep your eye on all of this. Now, the Senate has prioritizing making things permanent. That's something they want to do. As I said, it is a priority they may lose if they don't get the bird bath ruling to come out correctly on the issue related to current policy versus current law. Right? And that current policy versus law is something only a tax policy wonk could really get into deeply, but it's an incredibly important issue. Current policy means we assume even things that are scheduled to leave the law, we don't count it as costing money to extend them. Now, I will say, despite the fact that we count them as saving money, and even the Senate counts them as saving money when they terminate the ones in this bill, but that probably is the thing that causes most people to say, how are you going to explain that? How do you explain that? Or, by the way, should we just consider the tips and, the exclusion for tips, the exclusion for overtime, and the exclusion and the special senior deduction? Should we just consider all of those permanent? And then we got a scoring problem out more than 10 years. Can you really have it both ways? Well, the Senate's trying. If I had to bet, I would think they're going to lose that try, but they're trying. So we'll see. Might be wrong. Maybe she'll say it's fine. Expect a lot of yelling if she does, and expect there to come back eventually if the Democrats are back in control, where they try to do the same thing with spending programs. Well, current policy, it doesn't cost more money to continue it, even if it's scheduled to go away. So yeah, I'm very concerned about current policy if you ever want to see deficits go down. That's a different problem. I consider the whole cutting it off before 10 years to be a budget gimmick. Now we're going to have a gimmick to get around the gimmick. So yeah, don't get me too deep on that. We want to stay off of this as much as we can, but you got to understand it to understand why certain things are likely to happen. They also are looking to prevent a tax increase of over $4 trillion with these things expiring. Why they want current policy is because if they don't have that, there's a $4 trillion cost they're looking at over the next 10 years. That politically right now doesn't sell well. So that's their problem. And also, while the House wants to extend that stuff too, they're trying to do it in a way that does not, in essence, where we have to take into account that we are spending to extend these things. So we have to make that up in some way, shape, or form to hit our goals. The House, because of that, has tended more to temporary extensions. They honestly believe that, look, the Senate's going to have to come back and do this anyway, so we're not going to go permanent and then wait for the Senate to come back and have to modify. The House probably really, really, really wanted the Senate just take their bill and vote yes on it. That was why they kind of cleaned it up. But I don't think, I think probably not the whole House bill wouldn't clear the bird bath, but I think a lot of it was set up. Yeah, we need this to clear the bird bath. So we're going to do this. The real catch is, and this is where the deficit hawks in the House and some deficit hawks in the Senate are a problem. It's pretty clear the Senate bill will have higher deficits in the future than the House bill, because the Senate proposed an additional $1 trillion added to the debt limit, debt ceiling when it comes out, right? We know we have to redo that later. While the House only proposed $4 trillion, that's a backdoor way of admitting the Senate bill is effectively about $1 trillion more expensive, right? We need a higher cap with the Senate bill in place. Let's talk about some of the key differences. The big one that's getting a lot of talk right now is the state and local tax cap. The House would increase the cap to $40,000, $20,000 for married filing separately. That would phase out when you went over $500,000 of modified adjusted gross income. And what it would do is to take you back down to the $10,000 limit. Now, the Senate, in what they say in their explanation is a placeholder, simply extended the current $10,000 cap. By the way, I would add, the House Ways and Means Committee did the same thing. The Ways and Means bill does not have the $40,000 provision in it. Only the bill that finally passed has this $40,000 provision. So if you have the House Ways and Means PDF printout, which a lot of people got as soon as they issued it, yeah, you're not going to find the House's, the $40,000 in there. You have to go get the updated version that passed the House, and then you could do it. Now, pass-through empty taxes, both of them look to limit the impact of state pass-through empty taxes in some ways. Not eliminate them, but reduce their impact. Now, what the House is going to do is simply say, if you're a specified service trade or business owner, you can't make use of it, from the specified service trade or business pass-through. You can't claim any of that as a deduction, right? Basically, except for maybe to backfill the 10 grand or 40 grand, but you can't claim the rest of it, right? Other owners of other businesses that are 199 Cap A qualified businesses would be allowed to continue to claim the full PTET deduction. Technically, it appears it would be an itemized deduction, would be subject to the AMT exclusion, so that would limit the benefit somewhat, but still basically, it would get you, especially with the higher AMT exclusion that both of these bills will allow, continue that. For most people, it would continue their PTET, right? Just if you were an attorney, CPA, any other sort of, physician, etc., sorry, you don't get it. The Senate did not pick on SSTBs by themselves, but they put a different limitation in, right? So what they said is, you can claim your pass-through entity tax subject to the following restrictions. Number one, if your total state and local taxes other than PTET, claimed on Schedule A, are less than $10,000, we will automatically allow you to claim the difference between 10 grand and what you actually put in. So let's say you had $6,000 of real estate taxes. You are a professional corporation. Let's say you're a CPA, and your only real income is from the CPA practice. That practice's PTET pays your entire, wipes out your entire state tax bill. In essence, you would immediately get $4,000. Then after that, we take a look at your PTET you're receiving, at minus the 4 grand, and we allow that deduction so long as it does not exceed the greater of $40,000 or 1/2 of the PTET allocated to you. So again, got my $6,000 here. I have left over $50,000 of PTET from the accounting firm. I'll be able to take $40,000 because $40,000 is greater than $25,000. Right? But let's say instead of having $50,000 left over, I had $30,000. Well, $30,000 is what I have coming to me. Because it's less than 40, remember it's the greater of, I'll just take the 30 left over. So that's the way it would work. The AICPA says, this is better than the House one from their position, because obviously for professionals, it obviously and by the way, our CPAs are right, SSTBs, yeah, I remember that, right? The ABA says it's good too. Attorneys are SSTBs, yeah. It is better for professionals. Is it better for your other clients? That gets to a really big, it depends. What it really depends on is, do they have $40,000 of state taxes? Right, in essence, or $40,000 plus whatever they're not using up another regular $10,000 on Schedule A. If they're below that number, then it's just as fine as it used to be. If you get above that number, you begin to lose part of your PTET. And eventually you're going to get only half the benefit you're getting currently. So that's kind of the trade-off there. Both of them permanently extend the bar under 6.7G of claiming miscellaneous itemized deductions that previously were subject to the 2% cap. However, the Senate puts in a special carve-out for educators. Unreimbursed employee expenses for educators are no longer considered a 2% itemized deduction. They're added to the list of things that aren't in Section 67B, adding them to 67B13 now is where we're going to find them. What that means is that the way I read the provision, you would be able to still claim your educator expenses up to the current limits above the line. However, if your educator spent more than that, which means you have an educator, they spent more than that, let's just put that straightforward, they could claim the deduction, but they'd have to itemize. It would not be subject to the 2% haircut, but it would be considered, as a deduction on Schedule A. So, it's some benefit, but again, it's not going to benefit a teacher who does not itemize deductions, right? Either that or that teacher needs to be spending a lot of money, right? Because that teacher's got to build their way up to their standard deduction, and then anything beyond that they would get. So, yeah, it could be helpful for teachers, but it's probably not going to be revolutionary because huge proportion of the population takes the standard deduction, and both bills will keep the standard deduction up where it is now. So my guess is probably 90-some% of teachers itemize, if not more, because the overall population is way up in that range now. Yeah, I suspect that that extra provision, it's useful in some cases, but not probably it would be more useful if that had increased the above the line deduction. But that's probably asking for way more than you're going to get, so you take what you can get. Personal exemptions would officially be killed permanently by this. We're going to keep, as we'll get to later, the child tax credit and the dependent credit, which is what basically substitute for them. We are going to get a brand new senior deduction. Both bills provide a temporary senior bonus deduction. Both bills provide it would apply from 2025 to 2028. So essentially, it would be, now the difference is the House bill would make it $4,000, begin phasing out of $75,000 for single, $150,000 for married filing joint. The Senate would put that to $6,000. The phase outs would start at the same range, but they'd phase out faster under the Senate bill. So that's what's there. This is in the bill, another Byrd rule problem. This is in the bill in lieu of an exclusion for Social Security taxation, for taxation of Social Security benefits. And it's in the bill because a bill under the Byrd rule, one of the things that it can't have to avoid having to go through the 60 votes to vote cloture and be able to actually get a vote on the bill, it can't change the taxation of Social Security. That means either up or down. Various issues related to Social Security cannot be touched in this bill. That's considered to be such a sensitive area that we need like a 60-vote margin to get it through. So that's why we're getting this temporary exclusion, this temporary additional standard deduction, or deduction, not really standard deduction because you get it either way, but yeah. But it does phase out at incomes above 75 or above 150. The child tax credit, the House would temporarily increase the credit to $2,500 per child, with a refundable portion capped at $1,400. The Senate would permanently increase the non-refundable base to $2,200 per child, but the additional tax credit, which would remain here, which is refundable, would not be subject to a cap. The QBI, Qualified Business Income, Section 109 Cap A, both bills make it permanent. The House bill would raise it to 23%. The Senate bill keeps it at 20%. The House bill would make some modifications when somebody goes over the threshold amount, which will primarily have a negative impact on SSTBs. If you don't have wages, those would be the one most negatively affected. Otherwise, it could positively affect you. So we'll just leave it at that. It's messy, and I don't want to go through the technical details of that because, again, may never become law. In the Senate, the deduction will be kept at 20%. It does expand the phase-in range once you're over the threshold amount, so it's just over a longer period of time. There would also be this weird inflation-adjusted minimum deduction under QBI of $400 for taxpayers at least $1,000 of QBI. That is a very narrow range of taxpayers. for which this is going to make a difference. Like, it's going to be somebody who has QBI between 1,000 and let's see, we get a benefit of 150, right? Because we go from 400 to 600. So yeah, we'd naturally get 600 at 1,800, or we naturally get 400 at 1,600. So basically, apparently for this mob of taxpayers that have qualified business income of 1,000 to 1,400 on the returns, this is who this is for. I'm trouble getting really excited about this because, like I said, the max benefit's $150 deduction. So we're looking at very little tax. This is one of the provisions I look at and wonder why? Why did we spend time on this? Who had what? Whose kid? It's got to be somebody's kid, is my theory in the back of my mind. Somebody's kid had a lemonade stand that earned $1,200, and they're all upset because they got so little QBI, so we're going to give them 400 for sure. Yeah, this one to me just makes no sense, but it's there. No tax on tip, no tax on overtime. Both propose allowing deductions and exclusions for 25 to 28, but they do approach it differently. Under the House, we generally don't have deduction caps, but we exclude it for how they compensate employees. Under the Senate bill, tips are capped at the 25,000 exclusion, overtime at 12.5 or 25,000 for a joint return, and then phase out a higher modified adjusted gross income. There's not the cliff that we have in the House bill. To me, the House bill, the problem with me is that's a cliff. I hate cliffs. Cliff means $1 of income. You go from being able to exclude all of your tips to being able to exclude none of them. You go from being able to exclude all of your overtime to be able to exclude none. So essentially, we don't use that mess. Both extend bonus depreciation 100% or restore it back to that, but the House only through 29, the Senate would make it permanent, at least for now. Research experimental expenditures. The House would reinstate domestic, but not foreign, expensing for 2025 through 2029. The Senate would restore domestic, and again, not foreign. Foreign would still be amortized, but they would make that permanent. Secondly, if you're a small business below $31 million of gross revenue, you would be able to retroactively go back and retroactively reduce your deductions, amend your returns for 22 through 24, okay, to basically claim a refund and, get whatever your interest and all that, whatever interest and other stuff you'd earn on that as the IRS finally processes it. Or for everybody, you could simply have a 481A adjustment to catch up the cost you deducted in 21, 22, 23, and 24, claim them all in your 25 return. Standard 481A adjustment structure. And then go forward with these things being amortized. Or we go over these four things being expensed and no more amortization. The real issue there, if they put a provision like this in the bill, is your clients have to decide whether it's worth the cost of amending the return and waiting for a refund to be processed. By the way, that's not a very fast process. Or is it just better for them to just go ahead and take the full deduction on the 25 return, right? Pick it all up this year and offset income for this year. I suspect there will be both pros and cons to both. We'll just have to see. I think a big question is going to be, how big are your expenditures and what's that going to do? Are you going to get a whole lot of low tax bracket benefit if you take it all this year? Maybe it's better to go back and get higher bracket income in the earlier years, but you got to factor into that the cost. And it would appear the 21 just has to come through. Now, the business interest rules under 163J, you may remember that we went from earnings before interest and taxes as our basis for determining our business income to take the percentage times. And we decided to kick that up to earnings for interest, taxes, amortization, depreciation, and depletion, right, in recent years. This would take us back to the old method of EBIT beginning in 25. This one, earnings before, I should say earnings before interest and taxes, depreciation amortization, right? That's what we should return to, is typo on the screen. We would return to that calculation with no expiration, be permanent. And also, the Senate bill would modify definition of motor vehicle, which would mean flooring interest would be expanded. You could have an expanded definition of flooring interest. Okay. There are changes to the GILTI and the FDII. You'll notice there the House will change the FDII rate to 36.5%, the GILTI rate to 49.2% of 2025. Senate will provide a smaller increase in FDII to 33.34% and GILTI 40% rates, and propose to eliminate the substance carve-outs. The base erosion anti-abuse tax, otherwise known as the BEAT, the House repeals the scheduled increase, instead increases it only to the 10.1%. The Senate also repeals the scheduled increase, reduces the threshold to 2%, and potentially increases the BEAT rate to 14%, and introduces an exemption for foreign tax payments. So again, in both of these cases, for the GILTI, FDII, I say all three of them BEAT, yeah, there's got to be some reconciliation of these provisions, to get them in line. The revenge tax, the enforcement of remedies against unfair foreign taxes, Section 899, be added to the code. They both have a version of it, but they have somewhat different provisions. The House proposed a 20% point cap on the punitive tax rates assigned to those investing in U.S. operations, where the U.S. for those from bad countries on their U.S. income. The flip side of that is the Senate is going to cap at only 15% rates. The effective date be no earlier than January 1st of 27, not next year, and it would exempt U.S. Treasuries from this extra tax. I think the Senate realized, which actually makes sense, you probably should realize this, that we're having trouble selling Treasury debt right now. It's not a good time to reduce your market. Just saying. The Senate also increased the deemed paid credit allowance from 80% to 90% for GILTI inclusions for the foreign tax credit haircut. House bill has nothing along these lines. Both bills will increase Section 179 expensing. Goes to $2.5 million from $1 million. Reduced by costs exceeding $4 million. They both extend opportunity zones in somewhat different ways. The House would end the current opportunity zone and authorize a single new round, while again, the Senate tends to go more permanent. They establish a permanent policy, and they would create a rolling 10-year opportunity zone designation that would update every year. The green energy terminations, both propose significant cuts to these credits. The Senate is going to be much more aggressive about cutting these provisions, and the cuts are going to happen much faster, particularly for consumer-facing tax credits, especially for solar and wind, right? And EVs also in that mix. It's going to be much less generous for those. The House, for clean vehicle credits, the House will terminate the previously owned credit after 2025, the clean vehicles after 26, and the qualified commercial vehicles after this year. The Senate's going to speed up that termination. Previously owned would stop 90 days after the date the president signs the bill. The clean vehicle credit would end 180 days after the president signs the bill. And the qualified commercial credit would also end 180 days after they sign the bill. Plus, they would add eligibility requirements that would have the effect of reducing but not eliminating the lease benefit, right? The benefit we had before where you couldn't qualify for a credit, or your car couldn't qualify for the credit. But if for the individual credit, but if you restructured it to be a business credit, or you restructured it so that it was like Audi getting the business credit and then giving you basically in computing your lease cost, considering the fact they were getting the money, the $7,500. That was how many car companies were getting around the limitations on the standard clean vehicle credit. This would still work to get around certain parts of the limitation on the clean vehicle credit, but it won't get around them all. Certain ones now would apply, including battery sourcing would suddenly apply to them. Energy production credit and investment credits, so Section 45Y and 48E, the House would phase them out in 2019 until they were 0% after 2031. The Senate just accelerates the phase outs for wind and solar. They begin in 26. with a 60% credit, reduces to 20% in 27, and terminates them by 28, 3 years earlier than the House version. There's some IRS procedural issues. Direct file program is terminated within 30 days after passage and appropriate funding to the IRS to research a brand new public-private partnership to replace it. The House mandates the IRS use artificial intelligence to reduce and recoup improper tax payments. The Senate said, we're not doing that. So, we'll see. That's the sort of thing I definitely could see getting dropped in conference. We'll just see who argues hard for it. I'll put it this way. That doesn't really seem to have a major cost component in it. So I have to believe that the Senate, Senate Finance Committee chair just is not thinking that's a good idea. Would be my guess. That's why it's not there. ERC is interesting. The House initially included retroactive relief, basically repeal of claims filed January 31st, 2024, and other provisions from the bill that didn't pass last year. But it was struck. A lot of that was struck from the bill the House passed. The Senate would bar the IRS from paying claims filed January 31st, but only for claims from quarters 3 and 4 of 2021. So if your claim came from before that, I guess their theory is, well, before that, you had legitimate, there were a lot of orders, restrictions related to COVID through the first half of 21. But by June of 21, they were gone most everywhere. So their theory is that when you get to quarter 3 and quarter 4, that's when they start believing they're much more likely to be abusive. And so they would just block those. And also increases enforcement for bad actors, promoters especially, and extends the statute of limitations to 6 years for claims. So promoters would be things they do after the date of enactment that would be considered to be not exercising proper due diligence, and et cetera, that could affect their assistance they provide to clients that they filed claims for, because actions after the date would suddenly be ones that they would be held accountable for. So that we always thought was a more interesting part of the bill that they had last year. So we'd see. And the statute of limitations would be 6 years, generally from the date the claim was filed. For ERC claims, that's, that means the IRS could continue examining them for a much longer period of time. Well, this has been the Current Federal Tax Developments for June 23rd, 2025. Current Federal Tax Developments, as always, is brought to you by your State Society of CPAs. You can email me questions. I'm at edzollers@currentfederaltaxdevelopments.com. I also pay attention to the Connect sites for the Arizona Society of CPAs, the New Jersey Society of CPAs, the Minnesota Society of CPAs, Idaho Society of CPAs, Illinois Society of CPAs, and Washington Society. So if you're a member of one of those societies and you post something to Connect and I see it, I may respond to you if I think I can give you a quick answer. So we'll take it there. Otherwise, we will see you all next week. Keep your eye on the Senate, because that's where the action is going to come. That's the key thing we've got to watch for now, but keep your eye there, see what happens. Do they actually get to the point where it looks like they'll have a bill ready by the 4th? Or does it look like we are probably blowing past the 4th and it's going to take a while to get this done? So in any event, we'll see about that. But whatever happens, I will see you next week here on Current Federal Tax Developments.